While tax-advantaged accounts like the 401k or IRA are crucial to prioritize for a successful retirement, the biggest downsides that they have is that you have to wait until you're at least 59 and a half to reap the true benefits. Many also overlook the fact that a traditional brokerage account allows you to have no contribution limits, no early withdrawal penalties, and you gain full control to access your money at any time, so you don't have to wait until you're 59 and a half or above to use the funds. But before we dive deep into things, my name is Sully, and all I ask is if you do find value in this video, that you consider hitting the like and subscribe button for future content like this. With that said, we need to first go over what really is a brokerage account. Now, a brokerage account is a regular taxable investment account that lets you buy and sell things like stocks, bonds, ETFs, mutual funds, and other securities. Think of it as your way of investing into the stock market, giving you the ability to invest your money into publicly traded companies around the entire world. And so to better understand how brokerage accounts work, you'll first have to open an account with a brokerage firm, which I'll have a direct link below to some of the top ones you may want to consider. But do know that to sign up, it typically takes less than 10 to 15 minutes, where you can then deposit money into the account and use those funds to purchase investments. Now, unlike things like treasury bills or CDs that earn a fixed amount of interest, a brokerage account grows based on the performance of the investments you choose. So all in all, if you invest solely into a few individual stocks, your portfolio may grow very well, but that may also contain significant risk that could end up costing you greatly. Where if you diversify your investments properly, and investments like index funds make this incredibly easy to do, with the right ones, they have historically provided investors strong growth with significantly less risk when investing over time. But understand that with traditional brokerage accounts, when you sell an investment for a profit, you do pay capital gains tax. But what's really important to know is that the rate you pay depends on how long you've held the investment prior to selling. So to sum that up, if you hold an investment for 1 year or less, your gains will be taxed as ordinary income up to the 37% federal tax bracket, which depends on your personal income. Where if you wait at least 1 year, these gains are considered long-term capital gains that are taxed with much better rates, as the highest bracket goes all the way up to 20% at the federal level, and some could even be at 0%. And don't forget that any interest earned or dividends triggered also have an impact on your taxes. Now, I'll mention more on that throughout the video, but as far as most major online brokers, understand that times have changed, and we are currently seeing pretty much all of them offer commission-free trading, no account minimums to get started, and many offer education resources and customizable tools designed for beginners to get started. Many platforms also allow you to start investing on the same day. They offer mobile apps to check things out on the go, and they are all for the most part super easy to get started with, and like I said, it could really take you less than 10 to 15 minutes. But all in all, the key difference between a traditional brokerage account and tax-advantaged accounts like a 401k or IRA is the fact of no contribution limits, no early withdrawal penalties, and complete control over your money, which is why it can be such a powerful tool for building wealth on your own terms. Because of that, let's now go over why brokerage accounts are underrated. With all the perks of a brokerage account, the most important factor you need to be aware of is how much you pay in taxes. Taxes are brokerage accounts' biggest downside, and it's why the term tax reg is crucial to understand. I emphasize this because if you use brokerage accounts poorly, like consistently buying and selling stocks quickly, or having high dividend paying investments that trigger ordinary income taxes, that could easily lead you into a 1 to 2% tax reg every year. And as this image shows, with a $500,000 portfolio, after 20 years of averaging 7.5% per year, that 1 to 2% difference could end up costing you hundreds of thousands of dollars over time. But the thing is that if you understand how to use the accounts properly, taxes could be minimal, even none, depending on how you invest. That alone is what can make brokerage accounts one of the most powerful tools for financial freedom, especially if you want that before the age of 59 and a half. And unlike certain accounts like 401ks with strict plans, brokerage accounts give you that flexibility to invest however you want on what you believe is best. And if you truly aren't confident on your own, you could also consider things like robo-advisors or just spend more time watching content like this. But the most underrated thing here to understand with brokerage accounts is that you can gain that freedom with your funds before the standard retirement age And if you do things properly, the tax treatment could still be very good as well. This now leads me into discussing how you could actually use them for the maximum amount of freedom. The first rule I believe is best when using taxable brokerage accounts is to always look and ensure you trigger long-term capital gains rather than short-term. To ensure this, first, make sure that any investments you sell, you have owned for at least 1 full year. Most brokerage firms in the US by default do what's called FIFO, that stands for first in, first out, and the IRS states this rule pretty much means that when you sell shares, the system assumes you're selling the ones you bought first, not your most recent purchase. In other words, you sold the oldest shares you own first, and this matters because it affects how your gains are taxed. For example, imagine 2 years ago you bought $20,000 of the S&P 500 ETF VOO, and 6 months ago you bought another $10,000. Now let's say that your investment has grown to $50,000 and you decide to sell $10,000 of it. Using FIFO, the broker treats that sale as coming from the $20,000 you bought 2 years ago, and since you've held those shares for more than a full year, any profit is going to be taxed at the long-term capital gains rate, which is much lower than short-term rates. In other words, FIFO usually works in your favor by default, helping you pay less in taxes when selling investments you've had for a while. And best of all, if we look at the long-term capital gains tax bracket for 2026, you can see that the federal tax rate is 0% if you are single and have an income of less than $49,000. But what's interesting is to not forget to factor in the standard deduction, where for 2026, that is roughly $16,000, which means if your total income is less than about $65,000, including the long-term gains in that you'll end up paying no federal taxes. And say that you live in a state like Florida with no state tax, you'd be off the hook entirely. Knowing that, let me give you a real-world example on how beneficial this actually could be. Now, let's just speak hypothetically that you have $300,000 in your brokerage account and you are a single filer and your total income is $50,000 per year. Now, a popular dividend ETF I like is through Charles Schwab with the ticker of SCHD, where this ETF has a low cost of 0.06% per year. It's grown over 12% per year over the past 10 years, and it has distributed almost 4% of a dividend yield over the past 12 months. But the best part of all, and why I mention this, is because the dividends here are reported to be 100% QDI, short for its qualified dividend income percentage. And this means that they are going to be triggered as qualified dividends. And if we look back to that previous example and say that you invest 100% into SCHD, that means a 4% dividend yield would trigger $12,000 in dividend income. And also know that many strong dividend investments like SCHD also pay quarterly dividends. So that means that you would actually get paid out $3,000 every 3 months, and the dividends would be triggered as long-term capital gains as long as you held on to it for a while. And so with this example and saying that you live in a state like Florida with no state tax, that means you would pay no tax on your $12,000 of income from dividends in a traditional brokerage account. To emphasize this example even more, if you did this over the past 10 years, your investment would actually have also grown in value, where today that would equate to almost $650,000, which assumes that you've taken out the dividends every quarter, and those dividends would also increase over time as well, so it would be a win-win. But it's still important to be aware that if your income is above that 65K mark, or let's just say you get into the 15% long-term gains bracket or higher, and you live in a state with high state tax, this approach may not make full sense to go forward with, and so it really depends on your personal situation and what you're looking for. For those young and not interested in a dividend income before retirement, or the tax impact doesn't make much sense for you based on your personal situation, the best approach I like here in brokerage accounts is actually to solely invest for growth. The reason is that when you invest into growth stocks, these are among the most tax efficient investments because they typically pay very low or no dividends at all. That sounds crazy after what I just said, but for many not interested to live off of a dividend income lifestyle with a low taxable income every year, with the ability that you can end up paying 0% in qualified dividends, growth stocks could actually be your best bet. I covered this entirely in a recent video, so I'll have that linked in the description below if you want to check it out after this video. But using an example of someone in the middle-ranged tax brackets, the investments you choose have a huge impact on overall returns and how much you keep in your pocket after many of the years that you invest. To sum it up, the difference between a high-income fund like JPI that triggers majority ordinary income, that could end up actually costing you a 1.65% of an annual tax drag, where something like SCHD with qualified dividends could end up being 0.6%. And then if we look at even more tax efficient investments like VOO, that would end up being 0.18%, and a large cap growth ETF like SCHG would be 0.06%, which has nearly no impact and allows you to keep more money in your pocket over time, allowing more growth in your brokerage account. And in my opinion, that can make a brokerage account among the most powerful investment account one could use for freedom, especially before retirement. And not to mention, besides the tax structure, but a growth fund like SCHG has actually recently outperformed the market, where over the past 10 years, it has averaged an 18.59% annual return. So all in all, when it comes to brokerage investing, because the investments and the income you generate are going to be taxed, you would ideally want to look for the ones that are the most tax efficient options. As you can see, this image portrays some of the most tax efficient investments that you could use in any account compared to the least efficient options you'd rather try to avoid in taxable accounts. And so just to mention a few, some of the best ones for brokerage accounts would be growth oriented stocks or funds, or broad market index funds, where some of the worst are high yield taxable bonds and bond funds, and then high turnover mutual funds. I'll also mention another nice perk about traditional brokerage accounts is that you can benefit from tax loss harvesting. This pretty much means that you are able to sell losing positions to offset other gains that you've already captured. In fact, the IRS states that if your capital losses exceed your capital gains, the amount of excess loss that you can claim to lower your income is the lesser of $3,000. And be mindful, for this to work, you have to avoid what's called the wash sale rule, where you shouldn't buy the same asset within 30 days before or after selling it. And the last point I'll mention on brokerage accounts is that with select firms, you are able to take advantage of what's called an S block, short for securities-backed line of credit, which means you're pretty much able to borrow against your investments. By doing this, you typically get better rates and you get to avoid having to sell any investments and triggering taxes. But knowing that, let's finish this off by summarizing the common mistakes to avoid. The first mistake is that it can be much easier when using a brokerage account to actively trade based on hot stocks or market trends, but numerous studies have shown how stock picking has a terrible track record and it's only getting worse. Aside from that, another common mistake is not having a clear plan, but understand that diversification alone is going to be your best friend. Way too many times you'll hear about investors being screwed over from a bad market and then be forced to sell, and that could end up costing you many years of additional time of having to work. And so by diversifying your investments and understanding what you safely need stored for the short term and long term, and for worst case scenarios, it is extremely important to understand in order to reduce the downside impact on your portfolio and overall finances. For things like an emergency fund, I typically prefer to have that stored elsewhere, like a high yield savings account, so that you don't have the urge to invest and make regretful decisions. And as I mentioned earlier on the tax impact, try to avoid short-term capital gains or ordinary income from being triggered when investing in brokerage accounts. All in all, with brokerage accounts, because they can be accessed at any time, you want to avoid emotional decisions, create a system with logical reasoning to follow, and stick to it based on your plan. Now, I've created much more content similar to this that I'll have linked in the description below if you want to check it out, and I'll also mention if you want to see some of the top brokerage accounts to consider, or even high yield savings accounts, I'll have direct links to them linked in the description below. End of the day, I want you to do what's best for your finances, but do know that depending on the ones you choose, I may earn a commission for it, which is greatly appreciated. And as always, don't forget to hit the like, subscribe, and notifications button for future content like this.